Hello, in this video I'm going to talk about the recent short squeeze on GME and AMC Entertainment. We anticipated the short squeeze on our trading group. Here is the post on May 10. I was talking about the fact that they rolled the calls for the next Friday, for May 17. There is some anticipation for a short squeeze, I think. The $3 call for next Friday is 0.23. So some of us bought the free strike price. On Tuesday, May 14th, went up 36.5x. So it is not the first time that I identified the potential short squeeze on AMC Entertainment. You can see those long signal posts on TradingView that I had. This is from January 20, 2021, when it was trading at $2.65 before it skyrocketed. Afterwards, I had those short positions until May 7, when I told you about the potential of buying the 3.5 strike price call expiring on May 17. Those were from the trading group here on WhatsApp, and on TradingView you can find this trading idea that I posted on May 7 of those calls that went up 22.65x or 2265% at their peak. Something interesting that I want to share with you in this video is the difference between a short squeeze and a gamma squeeze. As you can see, in 2021, GME went up 24x in 15 days, while AMC went up 6.6x. In a short squeeze, traders who have sold the stock short, example, they borrowed shares and sold them with the intention of buying them back later at a lower price, are forced to buy the stock back at higher prices to cover their positions. This buying pressure drives the stock even higher, causing more short sellers to cover their positions, thus further increasing the price. It creates a feedback loop where rising prices force short sellers to buy, further increasing demand and thus prices. Short squeezes often occur when there's significant negative sentiment or speculation about a stock, and a sudden positive development causes the price to rise sharply, catching short sellers off guard. A gamma squeeze, on the other hand, involves options trading. It occurs when options sellers, who are often large institutional investors or market makers, have sold call options, contracts that give the holder the right to buy a stock at a certain price, and need to hedge their position by buying the underlying stock. As the stock price rises, they need to buy more stock to maintain their hedge, which further fuels the price increase. Gamma squeezes are typically triggered by a sharp rise in the underlying stock price, causing the delta, the rate of change of the options price with respect to the price of the underlying asset, of the call options to increase sharply. This forces option sellers to buy more stock to adjust their hedges, leading to a feedback loop similar to a short squeeze but driven by options trading. So this is the difference between the two. One is made from buying the stock and the other by combining options with buying shares. That happens because sometimes they sell calls without having 100 shares per contract. It is a naked call selling that hedge funds are doing. So this is the chart. Those are the buy and sell indicators that I have. If you want a trial for the indicators, please write me your TradingView username and I'll enable the buy and sell indicators for you. TradingView is the platform that I use. This was my entry here, the entry that I mentioned on May 7, and on May 10, on Friday, just before the close, I mentioned the signal in the trading group. So this one made 22x, but the other one if you want to join my trading group, you have the link in the description of this video, went up 36x. And now, after this retracement here, I expect to see another leg up, but this time lower than the previous one. If you want to learn how to trade options and also technical and fundamental analysis, you have my trading course on Udemy. This is one of the best ranked trading courses on Udemy, 4.7 out of 5, almost 8 hours of videos and 61 chapters. I wish you many profitable trades.